Everyone likes to compare this current environment that we're in to the late 90s, right? Which you and I were younger when we lived through it, but still we lived through it. What do you think is genuinely different? What feels different about today versus like what's a rerun?
The one thing that's quite a bit different is, I would just say, market structure. The difference today is, we were just talking about this, I think, earlier. The market part of the market structure is the holding period has compressed significantly. I think it was data we were looking at suggested over 7 years down to like less than one, and so that's created a lot of different type of trading, much shorter term focus, obviously. The other thing is the market participants, right? So it used to be that, institutions, mutual funds, probably dominated the bulk of the trading. Today, there's a lot of high frequency trading, CTAs, that type of thing that's dominating, easily half of the trading every single day. Institutions still are in there. The data I looked at would suggest maybe on the order of 25 to 30%, with the remainder being, retail. So there is a lot of programmatic trading going on and algorithmic trading, and that is creating a lot of volatility that we used to not have on such a short time frame. That's probably the main difference, what I call the plumbing of the market.
Completely agree with you, and I think that market structure question is it's so different. So if you think about these CTAs, how much do you think it affects the intraday, the daily flows that are happening in the environment that we deal with? If a company reports earnings or a news announcement, any of the typical fundamental stuff we look at.
Yeah, I mean, those traders tend to be very short-term focused. They have a very high momentum factor, if you will, trend chasing, things like that. They usually honestly set up algorithms based off of certain numbers and certain terms and things like that. And so as soon as the press release hits, a lot of times you'll see the stock will immediately drop significantly or go up significantly. And then you kind of get the sorting out factor, I guess I'll call it. And the good thing about that is, we'll take the time and we'll get into this thing with the time frames compressing. One of our advantages is, time frame arbitrage. I like to call it. Other people call it the same thing. And that's basically sticking to the fundamentals and letting these short-term traders do their thing, but trying to take advantage of the volatility. And that is the one thing that's happening more so. We've recently talked about how volatile the market's been just in the last few weeks. Around quarter end, Russell rebalance, this momentum factor thing, and then we're getting these factor flips every other day. This year has just gone off the charts between AI infrastructure and software. There's been 33 days of a 4+% move, and that's more than there's been in the last 7 years combined. And so that just embodies what we're talking about. And so the way we're trying to take advantage of that, as we've talked about, is we're trying to take advantage of the downside volatility in names we want to buy. And to the flip side, if we get one of those factors that gets very extended, we'll look to, maybe do some trimming if the risk reward isn't conducive.
Okay. So just for the sake of the audience and everyone listening here, and again, I know the answers to these questions, but do CTAs read 10Ks?
No.
Do CTAs run DCF models or even price target models?
Of course
not. Do they probably listen? Do they listen to earnings calls?
No, they have computers do all that for them.
They do.
Right.
Do they do fundamental analysis in the way that we would think about it?
Not the way we do. It's more event driven, I would say. Yeah, it's more things set up that will algorithmic or programmatically be pre-populated, and they'll trade against that in the very short term. Yeah.
If they don't do any of that, they're literally trading on the move that the stock makes.
Correct. We
based
call that
on an algorithm.
Correct. We call that the hot money.
So we have this hot money that's changed the market structure completely in the last 30 years. And you and I see it on a daily basis. And you brought up another term that we use constantly internally here, which is factor flips.
Yeah, we're using it way too much lately.
We use it way too right.
Every day, basically.
So explain a little bit what that is, because we're having one right now today.
I think there's a lot of things feeding into it. It's the short-term duration thing. It's the programmatic trading we're talking about. But then AI is creating a lot of this because obviously we didn't have AI or much of it up until 4 years ago when ChatGPT came out, right? But because of that, there's this big wide range of outcomes in certain things. And one to the upside, which we've been exploiting, is the infrastructure trade. And you're seeing CapEx budgets by the hyperscalers and the LLM companies going up dramatically every year. And, we're starting at 15%, and we're ending the year at, 60, 70, 80%. So because of that, people recognize that, and that's where the biggest estimate revisions are, the biggest growth rates. And so a lot of people are invested there. What tends to happen, though, is it becomes so obvious within shorter time periods, you go on big runs, and then it gets crowded. And then this hot money comes into play, and it gets hard to satisfy expectations. So you got that going on, but then on the other side of it, you have companies that are getting disrupted by AI, which tend to be the software companies, some services companies. And so people generally are betting against those, and so they're shorting them. So sometimes when the momentum factor goes too far and some of those stocks tend to go down a lot, they get stretched to the downside, you get these flips where, the momentum factor will go up, 5 to 10%, a group of stocks, then the software stocks will maybe be up that amount. And that's what we're talking about. It's because everybody is kind of long this basket and short this basket. And when it does the opposite, everybody panics, and they're trying to try not to get caught up in that because they're losing money on the trade. Now, if you're riding momentum, you've got more wins and losses for sure this year, but that can persist sometimes for a couple of weeks. That can be very painful, especially for hedge funds that tend to deal on monthly drawdowns.
Right.
Which again, that's hot money as well. It tends to be hot money.
So if since long only investors are only about 10% of the market as best we can tell, does fundamental analysis even work anymore?
Well, absolutely, because what ultimately drives stock prices is earnings growth, free cash flow growth,
right? Which
wins out long term. Short term, what we're talking about is more the short term duration, this changing in the plumbing of the market. But again, the way we're looking at it, and we've had a lot of discussions about this, is we're trying to use it to our advantage, and we're trying to take advantage of some of this hot money flipping around and being disciplined and using a process and taking advantage of that volatility on both sides when appropriate. And again, that gets back to this time value arbitrage. Just having a longer time horizon. Even Ken Griffin, who runs Citadel, just had a big conversation about this within the past week, and basically even said, now this is actually topical. I hadn't even thought about this. He actually basically said this short money thing is kind of over, which is a lot because they're very involved on that, high frequency trading side, money, making markets too.
Meaning that they're probably finding less profitability in those high frequency trades.
They're probably still going to make a lot of money because of the way they position themselves. But right. I think what he's saying is the short money game, the short time trading game thing is getting a lot harder. It's getting more crowded. Yeah. So maybe the thing to do is just step back and be a smart contrarian and realize that this time value arbitrage thing, there's some value to it. And maybe people aren't doing it because that duration has contracted from 7 years to well less than a year.
Right.
So it's like we've come full circle. Maybe we've gone too far.
Right.
That's kind of the signal, I think.
That's fair. And what do you mentioned when we talk about fundamental analysis, which we talk about on a daily basis, and what I'm trying to get you to explain a little bit about is our discipline that we have on stock. So there are typically what happens when we own a company is we buy it for the specific reasons fundamentally that we believe in. But if it starts to work, the fundamentals start to work, and then the quote unquote hot money takes over, it takes it to valuations, and you kind of referred to it to me before as this rubber band. You can only stretch the rubber band so far, right? So how does, how does this rubber band how do you think about it? How do we incorporate it in our day-to-day discipline?
I mean, the key is for anybody that does this in the business that's been remotely successful is they have a process. And the market can do a lot of things for certain time periods and you can go haywire, do things that cause you to be out of favor. But when you have a process, the process kind of keeps you in the game. It keeps you doing what you've done to be successful. And what our process involves, it's following the fundamentals. It's finding the companies with the deep moats. It's following the companies, owning the companies with higher than average growth rates, positive estimate revisions, things like that. Hopefully always we're looking for accelerating growth, things like that, characteristics, and in secular growing markets, right? But we also overlay that with a pretty disciplined, rigorous kind of, call it a screen, I guess, if you will, that's based that literally rank orders risk reward every day. And basically what it ends up doing is it kind of like shows you a menu of what you put into it in terms of when you think the risk reward on a certain stock is getting good, getting high or getting low. So let's say a 3-to-1 upside downside ratio starts to be pretty attractive. If it gets up to 5-to-1 or higher, that's great. If you've done the work and you feel good about it, you have conviction. Vice versa, when you're kind of below 2-to-1 or something like that, that's when you start to go like, well, is it approaching a price target? And so we're pretty disciplined about doing that. And to the point about momentum, what happens sometimes is when people start chasing these trades, that risk reward gets very low and it screens very, very low in our process, right? And that's when we trim names.
That's right.
Right. And the hard part about markets sometimes is they overshoot. And I don't think we're going to get into it. Maybe we will a little bit, but back in 99, 2000, the more disciplined you were for a while, the worse you did. And so you kind of have to massage these things for the type of markets you're in sometimes. And sometimes you need to maybe relax your rules just a little bit to be conducive with the environment you're in. You never really know at the time, but you just kind of have to, I guess when you've been doing it long enough, you just kind of get a feel for it in your gut sometimes, right?
Yeah, no, it's really helpful. It's funny that we've done fundamental research in the same way for so long, and you try to stay as disciplined as you can, but sometimes the momentum, you can kind of feel it taking over. And it's like, okay, do I want to hold on for another week or month or whatever the time frame might be? Because if momentum is going to take over it, all of a sudden we're going to, but usually we take small trims here and there. We try to make them methodical, very surgical, because we know that when it goes the other way, it goes the other way hard and it happens fast, especially in large cap. So the other dynamic I was going to get into that kind of falls into this is the other thing that's been happening that I think this market structure plays a huge role in is there's all these announcements about AI, right? And these companies move in crazy directions on any given week. And some of these have proved fantastically great opportunities for us to get involved in a company, and some of them have proved to be great ways to get out of a company. What are you doing from a research standpoint that's different today versus, maybe 30 years ago, maybe 10 years ago to validate or invalidate some of these news announcements? Because a lot of them get debunked within a few days. And if we prove to be right and we got involved, got involved in something, we can be very lucrative.
I don't think on the fundamental side, I'm doing anything dramatically different. But one thing I left out about the market structure, the other thing that's changed investing is social media.
Yes.
So when we got in the business, there was no Twitter/X. There was no Facebook, right? And a lot of what moves stocks intraday, a lot of news stories is actually put out on social media, and a lot of people are paying attention to it. So if a lot of people are paying attention to it, kind of like technical analysis, you kind of have to as well. But what we try to do is, we're doing our fundamental research every day, and it's what I call data point investing. And so, having worked at UBS O'Connor, and when you do work for a hedge fund, one thing you learn about is that because you're dealing in these shorter term windows, you're really trying to, you got the bigger picture story, and you're owning it, hopefully for some type of duration. But you're working in shorter windows by definition. That's just kind of how the industry's kind of tended to operate. And so what we're trying to do every day is validate our research and get increased conviction by picking up data points and amalgamating them. And one thing that we do, which we don't really talk a lot about, but we do use it for the growth compass, is we use Microsoft Teams, and we load data points in all day long so everybody can see them. And what that does is it's not only putting it out there and we can pull from that, but everybody is able to see that and be aware of the same information. So that's kind of how I start my day. I'm picking up all that stuff from social media, from street research, putting it out there. And so when everybody comes in, hopefully they kind of see at least what the headlines are of the day that we should be aware of. And then we're just trying to validate by data points. And if we're starting to pick up data points that disprove our thesis, then we're talking about that very quickly, and we'll make we'll make changes in the portfolio. Yeah. But as you can imagine, as you know, with AI, the data points are coming fast and furious, day to day, week to week, and things are changing and moving very quickly.
Yes,
more quickly than I've ever seen in my career. So it's hard to stay on top of, and nobody has all the answers, but we do our best.
So another topic that, and I don't know how much of the CTAs or the hot money is involved in this, but in technology investing, there's a big discrepancy between large cap and small cap technology companies today, which is kind of the opposite of what we saw, I think, in the late 90s when all the equipment companies that were building fiber traded at very premium valuations and the smaller companies weren't. But today it's kind of the opposite, isn't it?
Yeah, it's interesting because having lived through that period and worked with a momentum investing team back in the day, the big difference is, in 99, 2000, you didn't have everybody calling it. I mean, I can't remember exactly, but not everybody was calling a bear market every day. People were kind of like partying in the streets. Like I had this pile, I always reference this, I had this pile of prospectuses on my desk, like 2 feet high. It was all CLEX. Remember the CLEX, the competitive local exchange carriers that were competing because the FCC allowed them to with the telephone companies, right? The old baby bells. And then there was all the internet companies. Remember those? Not many people do anymore because they didn't last very long. But, having to go through those prospectuses and deal with all that supply coming on the market, and they were trading at 200 times revenue and eyeballs and things like that. People were partying and, stocks were going up. They're outpacing their estimate revisions, and there is multiple expansion, weekly. The difference now is people are calling the peak every day, multiple people, because a lot of people missed it, frankly. Let's just be honest about it. And it's sour grapes until they want the market to go down. They want these stocks to go down to give them maybe a better entry point. But the multiples for the large caps, for the most part, are compressing. And, there's certain of the Mag 7s, the hyperscaler types, it's more understandable because they're free cash flow. They're spending all their operating cash flow on CapEx. Right. So that's more understandable, but it's the merchant suppliers. Yeah. So it's kind of like, it's like the world leading GPU company, that type of thing. Those, they're blowing the lights out, and, people don't want to pay, a teens multiple, but they'll pay a much higher multiple for companies that are growing quite a bit slower. Yeah. And so it's almost like you're already pricing in a slowdown before it even happens, which kind of almost prevents a bubble in and of itself. So there's almost like people have been talking about this. They're calling it a bubble and calling it a bubble. Yeah. And there is some of that. So actually, a guy that I really respect called Gavin Baker, he was talking about this. He was actually saying, hey, you have Michael Burry out there pointing out data points and trying to call the peak constantly. He's like, great. Like, we need people out there because it's actually setting the table to kind of like prevent it, to keep expectations low. And that was his point, is like he almost wants that because it keeps things more in check.
Do you think let's say you had this AI revolution in the late 90s. I mean, this is completely theoretical.
Yeah.
But you like to get philosophical at times. So we'll throw this out there because I think you made me think of an interesting question. If we were in the late 90s, do you think the large cap tech companies would get that party multiple, everyone out partying in the streets, that they don't get today? Like, what's changed in our society? I don't need to get into society, but there's something that seems to be different.
That would be what would typically cause a bubble, right? When it's multiple expansion, people keep chasing them to whatever valuation level. And I get what people are concerned about is a sustainability.
Yes.
But when you start implying a growth rate that is significantly slower than what these companies are growing, you're already pricing that in. And that's the weird thing. I think it was Stanley Druckenmiller that said, actually, when he sees a bubble, run towards it. And what he's talking about, and this might be part of his experience in the 99, 2000 timeframe, where he saw things getting loopy, and he decided to sit out. In the very end, he couldn't take it anymore. And he went all in with billions of dollars. And after the fact, he lost a ton of money. He goes, I knew what I was doing was wrong, but I just couldn't help myself. Right. So, but normally that's what happens when you have a bubble. Like, you're getting this massive multiple expansion. And like you said, with the large caps, you're getting the exact opposite. Obviously, we have to differentiate like we're talking about. But that is the thing, is you would think that the leading internet networking company back then was trading at like 130 times forward earnings, right? The leading GPU company is like 15 times, growing 100%. So those are just kind of the facts. We can debate the sustainability, but that's where it sits today. There's a big difference there, just purely in terms of valuations.
Information obviously flows faster than it did 30 years ago.
Yeah.
What other factors would be at play today why, the things you just mentioned are in a way kind of preventing a bubble of sorts in the large cap arena? Is there?
Yeah, it's a good question, and a lot of people are asking that. And I think the easiest explanation is these companies, the market caps have gotten so large, and some of these companies are so widely held, it's just harder to get the incremental buyer. So it's kind of like a technical volume trading issue as opposed to like a fundamental hardcore analysis. And then if you get IPOs, like we've had IPOs and we're getting more IPOs potentially coming up, there might be people that are saying, hey, I own a lot of this. Maybe I need to make some room. I'll just take some out of this. It's a massive weight for me.
Right.
And whether it's working or not, you can debate all that. But sometimes it's by virtue of the market cap. It's just hard to move 4 or 5 trillion market cap companies sometimes, especially when people have been so had a lot of success in these companies. They can't technically own a lot more percentage wise in their portfolios. Right. And so I think there's definitely some of that going on. Other than that, I can't explain it because the fundamentals don't really, maybe eventually we'll see why. That's usually like the stock is telling us something type of analysis. Right. But this has been going on for multiple quarters now. It wasn't like a 1 quarter thing. So
do you think the sort of last question just wanted to get in, do you think the small cap premium is deserved that a lot of the AI ecosystem-ish or esque companies are getting?
Yeah, I mean, it's. I think obviously it depends. It goes stock by stock.
That is true,
right? I can't paint them all with the broad brush, but the way I look at the world, and I think the way most fundamental people do is, your stock price should generally keep up with your earnings line, right? If something is fundamentally changing, and all of a sudden the competition set, starts to come on in a big way that people aren't foreseeing, your multiple will compress, and that's very valid. But generally speaking, as long as you're not, as long as your earnings line is at least keeping up the stock price, I mean that's exactly what should happen. Right. So we're seeing some cases where you just get this momentum factor come in, and it's hard to imagine a lot of these companies. I mean, we just had a few on the large cap side that are not the Mag 7 do that in a month or two, and we've seen a lot of those gains get cut by a third or more very quickly. So it can happen in large caps too in a shorter time frame. There seems to be this thing with the Mag 7 types that they have this like boat anchor around them. And like I said, part of it is the hyperscalers and their cash flow. I get that, but there's other ones that are benefiting that are just kind of tied to that group for whatever reason. And so yeah, I mean, that's why I said I wouldn't paint it with a broad brush, but I think you got to go kind of stock by stock. And as long as they're earning it, I don't care what market cap company it is. They should get the credit. Yeah. Ultimately.
And so as we've just talked about this broad evolution, obviously in a very short period of time of technology investing in the last 30 years, what do you think the next 10 years hold? And that's kind of the broad question I'm trying to get at, which I know is very difficult to predict for both of us. But one of the things that I've thought about was agentic AI and how these AI I don't know if you want to call them bots or you want to call them computers, assistants, whatever they are, can start processing information faster for us.
Yeah.
I'm not trying to suggest that that's what you think it might be.
Yeah.
But is there going to be another part of our fundamental process, or how do you kind of see, like social media perhaps is what has affected and the internet, frankly, has affected the way information flows. So maybe in the next 10 years, what do you think the next item of evolution will happen when it comes to type of business we're in?
You mean market structure, or you mean like secular trends? Or both?
I mean market structure, not secular. I mean market structure and things that we have to evolve to. Like we've had to evolve with social media.
Right.
We've had to evolve with market structure and take advantage of it, right?
Yep.
Hopefully we'll other things will happen. So we have more ways to take advantage of the market.
Yeah.
I don't know what they might be.
Boy, I mean, that's a tough one because I just feel like this path we're going down with market structure, it just, we're talking about doing 24/7, 7 days a week trading too, right?
Yeah, I did.
Now you have all the Kalshis and all that, that kind of stuff that are kind of doing it. It feels like we just keep getting into like this more gambling culture. I personally don't like it because that causes weird things to happen in the market that probably shouldn't, all else being equal. It creates unnecessary volatility. But it feels like I don't know how much farther down this path we can go to passive, more CTA type of activity, high frequency trading, more trading. But I don't think it's a healthy thing. So maybe at some point we get a boomerang back, which if that happens, it's probably not going to be a pleasant environment. I don't know, but it's tough for me to answer because I feel like we just keep. This treadmill keeps speeding up and you can only compress the duration so long, right?
Right.
Which is why I mentioned the thing with Ken Griffin, because I almost feel like people are kind of saying this is going a little too far. Maybe we need to just kind of, hit the brakes a little bit. I don't know if the ETF sellers are going to agree with that, but we will see. But yeah, I think from that perspective, I that's my hope. I don't know exactly how it will evolve, but I don't know how it can get much more volatile than we're seeing right now because we're at all-time historic shorter-term volatility, and I don't think that's a good thing.
Completely agree with you. Maybe we could actually get a couple nights sleep here and there if we get this boomerang back, or it slows down. Maybe that would be a start.
Yes. Sleep would be great. I would agree.
We'll end it there, Chad. It was good chatting with you. Thanks for joining me today.
I enjoyed it.